Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. This is a special episode. I want to thank everybody so much for tuning in with us here today. My name is Andrew Kuhn, Focus Compounding, sitting alongside my partner here and co-founder, Mr. Geoff Gannon. Jeff, how's it going today?
It is going great, Andrew. How is it going with you?
It's good. We're back on our 3 podcast grind a week. No, this is just a special episode, really because we had sent out our performance, our Q3 performance on Twitter and to all of our investors yesterday, and I thought, why not dedicate a whole podcast to really just talk through the process? Obviously, our business has had, or talk through the quarter, our business has had a lot of different changes kind of on a going forward basis that happened in Q3, so I thought, why not dedicate a whole podcast to talking about it. And this was a very long letter. It took me 35 minutes to read. I don't even know how many pages is this.
Sounds right. It's close to 12,000 words, I think.
So it's very long, and that's what is going to be going forward. Obviously, in the past, for all of our clients, you would send a monthly memo, which was usually about a page. But now going forward, we are only going to, you're only going to talk to them via letter about once a quarter, so 4 times a year.
Quarterly.
But luckily, we do 2 podcasts a week, so if they want to hear your voice, come on over here to the Focus Compounding Podcast. So the title and the quote that you gave, which I thought was kind of interesting. I was laughing when I first read it.
A lot of letters start with a quote. So.
Yeah, but it's always like other investor quotes. I thought it was fun that it was my quote. And I started laughing when I was reading it. And it says, we're 0 for 2 on asset plays so far. Yep. And that was, I guess, the theme of this letter.
It is, yep.
And that story comes from, we were in Central Park in New York. Jeff was reading on his Kindle. We had about a few hours in between meetings. Yep. I was on my iPhone, kind of just reading some stuff. I also had an investor call. We got a good commitment in Central Park. Yeah. And then my iPhone died, and we were thinking about what could we do to sort of, spend that time well before our next meeting. And you said that you wanted to go look at condos.
Yes, at a condo project.
Yeah, you want to tell about that?
Constructed building. Yeah.
Yeah.
So there's a publicly traded company in the Trinity Place Holdings, right?
Which we don't own.
We do not own it, and we probably won't own it, as it talks about in this letter. But they have a property at 77 Greenwich, I think the property is called. It's the former Sims site, which was a retailer, and which went through bankruptcy and emerged from bankruptcy and turned this thing into a very big, very tall condo using the footprint that they had before from the retailer that they had. So they have a bunch of debt on it, and then once they pay off that debt with the proceeds from the condos, then the excess over that will create a lot of the value for the stock that you have. And that is, so basically it's an asset play where it's based on the performance that you'll get for how much per square foot that sells for is basically it. So if it sells for, $3,000 per square foot, you'll do well in the stock. If it sells for $1,500, you'll break even or something at today's price. I don't know the exact numbers, but something like that is probably what I was saying when we were at that bench in Central Park.
Yeah. And I had said, we're 0 for 2 on asset plays.
Yes, that's true. Because we had bought 2 different companies since we started the managed accounts. Last year, we bought both of them last year, but we sold one of them earlier, and then we just sold one this last quarter. One was Maryland and Pineapple. That was the earlier one, and the one that we just sold was what we refer to as Cool a lot in this podcast. Exactly.
And it was 4 miles away, so I was being kind of lazy, but also
4 miles away through Manhattan. I think I'm sure the phone said it would take 40 or 50 minutes.
And obviously I said that. But the reason why I did say that is because we have bought other businesses that aren't asset plays that have been great for us and our investors.
Much better. And that's what's talked about in the quarterly letter. Is why that is.
So you started with that, and then obviously you went to talk about our performance, which year to date we're up 37.8% gross.
Okay.
Obviously compared to the market, that's a pretty decent outperformance. So where do you think that outperformance has come from?
Well, the outperformance came from two stocks, basically. It came from NACCO and Computer Services. Yeah.
And we don't own Computer Services anymore,
No,
which you
we
talk
sold
about.
it
And
this
if you want to
quarter.
get access to this letter, check my Twitter.
Okay.
But also sign up on our email list because it goes out to everybody on the email list.
Okay, yeah.
I think. If not, it's going to. So,
It should have by now, yeah.
But go to my Twitter at Focus Compound. But yeah, so a lot of that performance came from NACCO, which obviously they have made some changes, or some different news has come out about the business over the past couple of weeks, really.
Yeah, they got a contract for a lithium mine. So for people who don't listen all the time to the podcast, NACCO does contract mining of lignite coal, which is obviously people are concerned about for like green perspective, from a climate change perspective and things like that. Coal is declining over time. The big thing that lithium is put into is batteries, especially for electric cars. So, I mean, maybe some people saw that there's a change in the company that, it has a better future that way. The stock probably went up as much as that contract would really be worth, though, is what I talk about in the letter, is that basically I didn't think the stock was expensive before the announcement, and I don't think it's expensive after, but I do think that the reaction to it isn't underdone. Because I'd say that reaction might be appropriate if there's like 100% sure thing that this is going to happen, but we're talking about a mine that wouldn't really be producing lithium until 3 or 4 years from now or something like that, and things can always happen. It's not as safe as a utility thing that way.
Okay, so then we went on to talk about how we are going to report gross returns going forward instead of net like we did before, and obviously that's because we are launching a new fund. There's about 4 different, I guess, between the managed accounts and the hedge fund, there's going to be probably like 4 different fee schedules. So just to make it a little bit more of an apples-to-apples approach, reporting gross
to not have
is the best.
Ask why is mine slightly different than
we talk about the announcement. Obviously, I'm sure everybody listening knows we partnered with Willow Oak Asset Management, which is
that's why we're in New York.
Yeah, that is why we're in New York. They are affiliated with Enterprise Diversified. They specialize in emerging managers, kind of handling the back office. They are going to do all of our fund management services. They're going to launch the fund. We have a great relationship with the chairman, Stephen Keel, and their team at Willow Oak. There's a lot of things that are going to come from it for us personally. That just made a lot of sense to partner with them. But we are expecting to launch that fund January 1st of 2020. It's going to be for qualified investors only, $250,000 minimum. Go to the website, it has all the information on there. I don't want to really bore you with that here. So then we went on to talk about asset plays, right?
Yes.
And you talked a little bit about KEWL and MLP, Maui Land and Pineapple, which we've spoken about both of those companies on this podcast, but maybe you just want to give a little snapshot of KEWL and MLP.
Yeah, so what I said in the letter is basically, why did I buy these things? Because they weren't really that much cheaper than Computer Services or NACCO. They really weren't cheaper. But it was more, I think, that of how sure you were that they were cheap. And not really how sure you were that they were cheap, but how easy it was to tell. Because you can look at something like an appraisal that someone did, or what the price per acre is, or whatever like that. And they were probably selling at anywhere from half to 2/3 of what they were worth. And yet I was saying that the businesses like NACCO and Computer Services, basically, if I did my calculation, which, I don't do a DCF, but if people are thinking that kind of the same sort of, you get to a result based on how much free cash flow it produces and things like that, I would have guessed that those were worth twice what they were selling at too. So it wasn't really more of a value play to buy those asset plays. But I did it, and it's more typical of like a Ben Graham type thing, And so I talk a little bit about like why that is,
One thing that was, funny is when we were talking about going to look at, the condo development and everything like that, we really started to go through the process. I'm like, okay, well, is it overlooked? We're like on my iPhone. We're looking at the share turnover. We're just doing all these calculations on our calculators and stuff. I'm like, okay, is it overlooked? We're like, okay, maybe it is, maybe it's not. I'm like, what's the market cap on the company? We went through there. It's a smaller company.
Yeah, I think 140 million.
Yeah, and then I was like, is it a good business?
Right.
And then you're like, no, it's not a good business. So then I'm like, why is it not a good business? And then you started to explain that. Do you want to explain why it's not a good business?
Yeah. So, I mean, it's taking the proceeds that are from the sale of these condos to buy apartments in Brooklyn at low cap rates, meaning high prices. It's paying very high prices for them. So once it reinvests those, it's not going to be great that way.
And then I thought it was funny, we kind of went down the process and we were talking about the businesses and you're like, so you want to go look at it? And I was kind of like, what did I say? I said, we're 0 for 2 on asset plays.
Yeah, exactly.
And then you wrote in the letter, what did you say? I thought it was really funny. You said like that's all you like needed to hear about it or whatever for the managed accounts, which obviously only 2 plays in is not a good statistical record at all.
Right.
But I just personally, of course you have full autonomy over the portfolio and the final decision making, but I just, from the businesses that we look at, it's like CSVI was such a no-brainer type of idea where there was no, it was just business as usual. You know, it was just a great company.
Yeah, like I said, it was good advice. So, and it's true. All of the poor performance from the managed accounts, all the negative performance on an absolute basis, certainly, and I think all of the on a relative basis, too. I think everything except for the asset plays has outperformed the market since we bought it. So it isn't just that the accounts did that through a couple things. It's basically that everything except for the asset plays have worked out, which is a matter of luck over such a short period of time, but is also an indication that I probably should have invested more in the better businesses and less.
And you had said that, and it's kind of like the Buffett and the Munger thing, where Buffett still does arbitrage, and whenever he tells Charlie that, Charlie jokes and says, "Well, it'll keep you out of the bars."
Exactly,
I guess if you kind of grow up with it, it's you still.
Yeah, and that's what I was talking about with the asset plays. I mean, we only buy those sorts of things anyway when we don't have. I feel like we have a good business to buy at a cheap price.
Totally. Yeah. So you talked about CSVI and you walked through the analysis with there, and then how you its competitor was Jack Henry and kind of the similarities between those two businesses. And oftentimes people, for example, with CSVI, it's a great business. It's trades over the counter, right? And a lot of people say, well, it's never going to trade at a premium, or I guess in relation to its public competitors that don't trade over the counter, they trade on a major exchange because it's an over the counter stock. And you talked about this at the Willow Oak event. You said you just buy it, you bought it, and the stock re-rated itself not as if it was like those other companies, but it still went up.
Yeah, that's a hard thing to do. I mean, we didn't pay a particularly high price for it. We paid, like I said, probably 15 times forward earnings or something for it. But and if you look at their competitors and their peers, they're bigger companies, public companies, they trade at really high PEs. Yeah. I mean, we sold, I think, at a 25 or a little bit more than that times PE. Several of these right now probably trade at 40.
Yeah.
Their peers. So it's true that, I mean, I guess people are right in the sense that computer services still doesn't trade at the exact same multiples as the companies that are like in the S&P 500 or something. But, what people often ask is like, what's the catalyst or something? And you've watched computer services. Yeah. What changed about the business in the time that we owned it?
Nothing. I don't know if anything's changed over the past 20 years.
Yeah. So, and yet we said, like, I think the annualized return was like 60% a year annualized, right? So, that's a very fast rate of growth in something in a stock price. That means significant re-rating if you're seeing something go up 60% in a year, basically. And so why did it happen? It just does. I don't know. Yeah. I mean, if you think that something's worth 30 times earnings or something, and it's trading at 15, then you buy it, and then eventually sometimes it does get a higher PE. Usually, you don't have to own it forever. But if we did own it forever, then it would be growing at a good rate, and it would be doing fine until such a point as the PE expanded.
Yeah. And then you went on to talk about the new stock that we own in the portfolio, which you wrote a little bit about that, Nekker.
Nekker, yeah.
Which is a stock that trades in Norway.
Correct.
And we bought that for net cash.
Yes, for net cash. Although the cash, some of it is customer prepayments. So I talked a little bit about that and said, I wanted to caution people that we paid less than cash for it, but it's not like we didn't pay anything for it, and trying to explain that. But on the other hand, if you look at like the PE or something of what it will be, it has no PE now because it got rid of like 90% of its business and paid out this dividend. So its numbers look messy right now. But like in a year or something, its PE will look kind of normal. And I'm saying, it's a lot cheaper than that because we bought it at, like we said, net cash, at less than the cash it has,
And we bought that pre-dividend before they paid out.
Yes.
I was getting up at 3 a.m. Central Time.
3 a.m. our time was when Norway opened. Yep.
Yeah, for a couple of weeks because we had to get so much of the managed accounts before the ex-dividend date.
Right. Well, I told you that, but as it turned out, that's not true. The stock didn't go. I mean, the stock didn't really go up after the ex-dividend date.
And the reason that we did that was because we thought it would go up more after. Because some people asked us about that. Clients, they said, why did you guys buy beforehand? Because you technically just got the capital
we should probably
back.
explain that a little better. So the stock was trading at maybe 7 times, not 7 times, but 7 Norwegian kroner.
Yeah.
And so it had said that it was going to pay out a dividend of basically 4 NOK per share. And so with the stock price at 7, we had significant concerns that that when that dividend was paid, it might not drop all the way down to 3, meaning in essence the stock would get more expensive on the day the dividend happened. And a real concern that the payment of the dividend stuff would attract attention to it.
Yeah.
That was a really big concern. It attracted a lot of volume. I don't know, it attracted a lot of attention.
I was gonna say, I mean, that volume was good for us though. Either way,
That was great.
You know,
yeah. And there was volume ahead of it too. There are people who I guess wanted to get out before the dividend or fine getting out before the dividend. There's plenty of volume, which is something that we needed. And yeah, for us, part of the calculation is that that company only has it's the equivalent of like $30 million in U.S. market cap. So it's necessary for someone like us, as opposed to like an individual investor, that we need probably a bit more volume. And so that is one of the decisions that we make, is when we think there'll be a lot of volume at a price that we would like. So we want the lower price and we want higher volume. And taking both those things into account, I felt more sure that we would get it before the dividend. As it turned out, it wasn't necessary.
Yeah.
But you just got up at 3 whatever and put in the orders.
Yeah.
Yeah.
That was fun. You continue on, talk a little bit more about CSVI, as we sold all of that, really just to buy Necker.
To buy Necker, yeah.
That was pretty much the only reason. And then you give a little bit of an update on NACO.
Yeah.
Which is still our largest position in the portfolio.
Yeah, and it's become much larger, which is why I talked about it. So normally we target about 20% of the portfolio position. We like to own about 5 stocks. We like to own them about equally.
Yep.
It hasn't been my policy. It has not been my policy to sell as the stock goes up, to like bring it back down to 20% or whatever. So
we don't rebalance.
We don't rebalance, which is something that most I don't know if most funds do it and stuff, but it's something that people typically talk about rebalancing. And like if a stock doubles or something, then they'll sell half of it to get back down to that level. And that's not something that we do. But it's something that I think about now, because NACO in people's portfolios has gotten to the point where it's about double the size of the second biggest position, right?
Yeah.
And that's just because it's an older position and it's gone up. So if a position's really new and or it hasn't gone up much, then it's not going to change much from where we bought it originally. But you have something like NACO, becomes a bigger and bigger part of the portfolio. And so I talked about it. And I just talked about how we originally put in the portfolio in low 30s or something like that in share price. And it's now in sort of mid 60s, like 64 or something as we're recording this, I think. About double. It's almost exactly double. And I explain why, although that would have been an appropriate, like today's price was an appropriate level versus my original appraisal for the stock, some things have happened that have made it more valuable. And those things are, one, just buildup of cash. So I talked about that. So, you have probably 10% or something of the market cap. It basically is just net cash that's built up since we got into the stock.
And can I say too, and I know I spoke about it on the podcast on Tuesday and then also on the margin of safety, because this is one of the most common questions, how do we think about margin of safety? I think most people think about margin of safety, and I use the example that they're going to buy it at 10, and then their margin of safety is they think it's worth 15. That's a big difference, and that's the way to think about margin of safety is like that. But we also think, okay, if we're going to buy it at 10 today and we think theoretically it's worth 15, but the companies that we invest in, they're all very high quality businesses, and maybe they have a 10% free cash flow yield, where theoretically if nothing happens to the stock for 10 years, you're going to get that buildup of cash. And so go ahead with that.
Yeah, so NAC, when we bought it, I expected that in 5 years we'd have all the cash back for the price we paid.
So that's what was baked into the margin of safety.
Yeah, so if we paid $30 to $35 a share, I expected that they would build up $30 to $35 a share in free cash flow over the next 5 years. Yeah. And they're on pace to do that, sure. In fact, to do it faster because of the natural gas.
Yeah.
So they started to have natural gas royalties come in. That was a small factor when we bought into the stock, so small that although I knew it was a positive value to the stock, I didn't really do an independent appraisal of what I thought the natural gas was worth. I just said, it has some value.
It was like a call option.
Yeah, exactly. And it's become significant. This year, they will probably earn more from natural gas royalties than from the coal business. So that's very meaningful. And I talked a little bit about how some people have sold out of it, and some people talked to me about it saying, well, should I sell out because now it's depending more on the natural gas, And, my attitude for that is basically I have trouble selling the stock unless we find something that is as good, as safe, as cheap going forward as it is now, as NACO is now. And with NACO, you have the lithium contract, which is speculative that way. Then you have the cash, which is very not speculative. And then you have the coal and the natural gas. The coal and the natural gas alone, just on their own earnings in a given year, probably support the stock price at $50 to $60 a share or whatever on their own. if they continued. But the question that people have is, well, what if the coal business drops off over time?
Yeah.
And what if the natural gas business drops off suddenly because, their reserves start running out because of how high the production is and they don't find new things and whatever. And those are both true. The stock isn't expensive on like a PE basis or anything like that. It's just concern of what if those things go away. And they might, but they're doing different things. They have a lime rock business. They'll have the lithium business. They have natural gas. They have coal. It's become less likely that all those things are all correlated completely and that they would all stop working at the same time. But, it's a risk, and it's always been something that people are fearful of that way. I'm not, we have no plans of selling all of it. We'd be willing to sell it down to a more normal position if we found something that I liked as much at a low enough price.
Yeah, for the purpose of a new idea.
Yeah, but just so people know, like NACCO's gone up. Like I said, it's probably doubled since about the time we bought it now. But the truth is that if you look at like on a PE basis or something, it's never had a double-digit PE. So you're talking about something that has no net debt, and that if analysts were predicting, which it's not really covered by analysts or something, but if analysts were predicting next year's earnings, the company already said that natural gas royalties will increase this year over next year for each of the next 2 quarters. So if you had a forward PE even today, it would be below 10 on the stock.
Yeah.
So usually when a stock goes up 100% or something, the reason why it would make more sense to sell it is because you bought it at 15 times earnings or something, and now it's 30. That's why you sell it. You shouldn't really just sell something because it's gone up 100%.
Yeah.
So, I still don't think you should sell something just because you'd still be selling something that has a PE of 10 or something,
What do they say? You never go broke taking a profit?
That's what they say all the time.
I hate that saying.
So, so people are thinking, should you sell because it went up a lot?
Sure.
Yes, if nothing else happened, then that would make sense. If there was no cash build, if there was no natural gas royalties, if it was just the things that we bought for originally, they're absolutely right. It basically went from half of fair value to what I think fair value is.
Yeah.
But they've produced other kinds of earnings and stuff, which is somewhat a matter of luck and somewhat a matter of that's what we were, in some cases, that's what we were expecting. I mean, not that we expected necessarily a lithium mine contract, but that's what the company been telling us for a long time is the sort of thing that they're trying to do is find other things to mine.
And the way that's structured as well is very, I guess, conservative, like the way that they structure their other contracts and stuff like that, very long-term oriented and stuff like that.
Yeah, and just quarter before, not that it's a big contract or whatever, but they signed it. One of the things they signed was a 20-year lime rock contract. They signed a 20-year lithium one. That's not so shocking because they had always tried to have 10 to 30-year contracts in the coal mining stuff that they did. And, they do surface mining. They could do surface mining of all sorts of different things.
Yeah. What I thought was interesting, too, and we were talking about it on the way here, is the volume has really started to pick up in the company as well.
Yeah, that is the thing that is...
And we've talked about before how, you buy these companies when they're liquid, and then they start to get more popular because the market starts to, maybe start to, realize it, or it just becomes more popular, or maybe it's the fact that maybe it's attracting a different investor base now that it's natural gas royalties and stuff like that.
Yeah.
But the volume has really started to pick up on the daily volume has really started to pick up on the company.
Yeah, and that's something I talked about in the letter, that basically if that sort of thing that you have to keep finding these things, that's the curse of finding these overlooked stocks, is that they become more liquid and stuff, and then you have to go out and find more overlooked stuff. I talked about the example of like beta and stuff. Basically, I was saying that investors as a group can't they wherever they go, they're going to end up with the same beta, basically. That if you are in a group of investors who are not focused on overlooked stocks, then if you decide, we're going to get out of stocks and we're going to buy gold, we're going to buy timberland, we're going to buy whatever, you're still going to end up with similar beta in those things, because as a group you're going to buy those things and you're going to trade it amongst yourselves and create that same thing. So that's why you see a huge correlation between things over time. Like it becomes popular with institutions and stuff to go into emerging markets, and now you look back and you go, wow, emerging markets are really correlated to the S&P 500 in a way they weren't when people originally pitched the idea of investing in emerging markets. And that's on a small scale the problem that we have.
Yeah.
If we buy something like NACCO or something, sure, it's still not too expensive, but you're right that it does over time get more recognized. That certainly happened with computer services, I think. It gets more recognized, and then eventually you have to find the next obscure thing and move into that. Otherwise, your stocks will eventually start to look more like the market.
Yeah.
And if you take that even further, like, if they start to get ahead of themselves and stuff another year or so in the future, then they can start to look more and more like the market. So you have to keep finding the kind of overlooked things. Because people ask the question a lot of like, they kind of assume that overlooked stocks will stay overlooked forever.
Yeah.
And they sort of don't. At the moment where the people are most pessimistic about them and whatever, they're really overlooked. And then gradually something happens that they get less overlooked.
Yeah.
And you could see that probably happening with NACO. That'll be less overlooked than at the moment of that spinoff.
Yeah.
Yeah. Because, I mean, everyone was really focused on Hamilton Beach brands, wouldn't you say?
Mm-hmm. Yeah. I mean, no one wanted the coal company.
Yeah, and now as they diversify into some other things and stuff, it'll probably get some attention from that more just as a normal stock.
I mean, we were talking to an analyst who he said, his firm looked over the company a few years before because the reasoning was that it was just a coal company. We don't want to be in the coal business.
Right.
You know?
Yeah, and the original reason why I had looked at it is because they had spun off some other things. While we looked at it to buy it and stuff was when they spun off Hamilton Beach brands, but I'd actually looked at it when they spun off High Street Yale. So those spinoffs and things do attract people to look at them in the first place.
Yeah.
But it does seem that people get more interested in the spinoff than in something like this. And it takes a while. I bet that's true with spinoffs and things like that it does often take a year or two for them trading on their own before they get a lot of people paying attention to them and things like that. Sure. Yeah.
Cool. Well, that is the end of this special podcast. Hey, email me, info@focuscompounding.com if you want an emailed copy, if you can't find it, or you don't want to go on Twitter, but I did tweet it out, which is @FocusCompound. If you want to get on the email list to receive these in the future, go to focuscompoundinggazette.com and you'll see a place to enter in your email. If you want to learn about the new fund or our managed account services that we offer to clients for investors, reach out to me, info@focuscompounding.com, and we could chat. Or you could go to the Invest With Us page on Focus Compounding.
Yeah, you'll put that up on the website.
It will be on the website,
So if people can go to focuscompounding.com, there's a whole Invest With Us page. It'll have this. It's got, that shows the performance, but also shows like all the past things that we have.
Yeah, frequently asked questions, pretty much everything you need to know. So definitely do all that and reach out to me if you're interested. I want to thank everybody so much for tuning in with us, and we will see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.